If you're earning a steady income in the United States and someone depends on that income, there's a quiet question sitting in the background. If that income stopped tomorrow, how long would everything keep working the way it does now? Most people assume life insurance is about replacing a paycheck. That's part of it, but it's not the full picture. The real question is how long your financial life can continue without disruption, and what it would cost to keep it stable. Income level changes that answer in ways that aren't always obvious. A household earning $60,000 a year faces a different set of trade-offs than one earning $250,000, even if both have similar family structures. The numbers change, but so do the risks. One common shortcut you'll hear is a simple multiple of income. 10 times your salary, sometimes 15. It sounds clean and easy to remember, but it ignores timing. It ignores debt structure. It ignores how long that income actually needs to be replaced. For example, a family with young children may need support for 2 decades or more. A household with teenagers might only need a shorter runway. Someone with no dependents but significant shared debt has a completely different exposure. So instead of starting with a multiplier, it's more accurate to think in layers. First is immediate financial shock. This includes funeral costs, final medical bills, and any short-term expenses that appear quickly. In the U.S., these can vary widely depending on location and circumstances, but they are rarely insignificant. Second is debt continuity. Mortgages, car loans, credit balances, and in some cases, student loans. Not all debt disappears, and in many situations, surviving family members are left managing those obligations. Third is income replacement over time. This is where most people focus, but the question isn't just how much, it's for how long. A single-income household with a stay-at-home parent has a very different exposure compared to dual-income households, where both earn similar amounts. Fourth is future obligations. College funding is a common example. Some families plan to cover it, others expect shared responsibility. But if that plan depends on a specific income stream, it needs to be accounted for. Once you break it down this way, the idea of a flat multiple starts to feel incomplete. At lower income levels, coverage decisions are often constrained by budget. That's a real limitation, not a theoretical one. Premium cost matters, and people make trade-offs. The focus is on protecting against immediate disruptions, like housing stability and basic living expenses. As income increases, the conversation shifts. There's usually more flexibility in premiums, but also more complexity. Larger homes, higher monthly obligations, private education, and long-term financial goals all expand the scope of what needs to be protected. This is where oversimplified advice can quietly create risk. Higher earners sometimes rely on employer-provided life insurance, assuming it scales. In many cases, it doesn't fully reflect the lifestyle or obligations tied to that income level. If you've tried to estimate what your household actually spends, you know it's rarely just your salary divided by 12. There are irregular expenses, seasonal costs, and long-term commitments that don't show up in a basic monthly view. That's why coverage planning tends to work better when it starts from expenses and obligations rather than income alone. As you think through this, pause and consider your own situation in practical terms. Not abstract numbers, but real ones. What would need to be paid next month, next year, and 5 years from now if your income were no longer there? If this breakdown is useful, save this video so you can come back to it when you're ready to run your own numbers more carefully. Because once you move past general rules and map your actual financial structure, the answer becomes more personal and more precise. And that's where the real planning begins. Once you start thinking in terms of expenses instead of income, the next step is translating that into a time horizon. Not every dollar needs to be replaced forever. Assuming it does, can lead to overestimating or underestimating what's actually required. In many U.S. households, the largest fixed obligation is housing. If there's a mortgage, one approach is to ask a direct question. Should the insurance be enough to eliminate that payment entirely, or just support it for a defined number of years? Both approaches are used, and the right choice depends on how the household would realistically adjust after a loss. For families with younger children, the timeline often stretches longer. Childcare, education, and daily living costs can extend well into the early 20s. In these cases, coverage is often structured to support a long runway, not necessarily to replicate income indefinitely. The goal is to allow stability during key developmental years, ensuring the family's foundation remains solid. For households with older dependents, the window is shorter, but not trivial. High school years can still involve significant costs, and transitions into college or work bring their own financial pressures. The planning horizon compresses, but it doesn't disappear. Every stage requires a specific calculation. Income level influences how these timelines are funded. At moderate income levels, there's usually a tighter balance between current expenses and savings. That often means insurance carries a larger share of the risk if something unexpected happens. At higher income levels, there may be existing assets that can absorb part of the impact. Investment accounts, retirement savings, or other reserves can reduce how much insurance is needed. But this only works if those assets are both sufficient and accessible without disrupting long-term goals. One area where people frequently miscalculate is assuming all assets are interchangeable. Retirement accounts, for example, may have tax implications or penalties depending on how and when funds are accessed. Using them as a substitute for insurance isn't always a clean swap. Another factor that changes with income is lifestyle inertia. Higher-earning households often have expenses that are harder to reduce quickly, such as private school tuition or larger homes. Higher baseline spending means a sudden drop in income doesn't immediately translate into lower expenses. This is why coverage planning at higher income levels often focuses on preserving flexibility. Instead of forcing immediate lifestyle changes, insurance provides time for adjustments, whether that means downsizing or restructuring investments. For dual-income households, the calculation becomes more nuanced. If one income disappears, the other may still cover a portion of expenses. But that doesn't mean the risk is fully offset. The surviving partner may need to reduce working hours, especially if there are children involved. There's also the cost of replacing non-financial contributions. A parent handling childcare and household management provides real economic value. Replacing those roles can introduce new expenses that weren't previously part of the budget. At this point, it's worth addressing a common misconception. Some assume that once debts are covered, the job is done. In reality, the structure of the payout matters just as much as the total amount. A lump sum can be powerful, but it requires careful management to turn it into a sustainable income stream. Strategies that align with ongoing expenses may be considered, depending on the individual situation and available products. It's not just about how much families earn, how their financial lives are structured, and how long support would be needed. If this breakdown is helping, tap the like button so this video reaches more people trying to make sense of these decisions. The goal is to understand the moving parts well enough that the number you choose actually reflects your real-world situation. Up to this point, the focus has been on what needs to be covered and for how long. The next step is translating that into an actual coverage range that aligns with different income levels in the U.S. without relying on oversimplified rules. For households earning around $50,000 to $80,000 per year, the margin for financial disruption is usually thin. There's often limited surplus after monthly expenses, and savings may be modest. In these cases, life insurance typically carries a larger share of the protective role. A practical approach here often centers on securing enough coverage to stabilize housing, eliminate high-interest debt, and provide several years of basic living expenses. It might mean a range that covers the mortgage balance, outstanding obligations, and a defined period of income support. The exact number varies, but the structure tends to prioritize immediate stability over long-term wealth preservation. As income moves into the $80,000 to $150,000 range, the situation becomes more layered. Many families in this bracket are balancing mortgages, childcare, and early-stage investing. There may be retirement contributions underway, but they're not yet large enough to absorb a major financial shock. In this range, coverage planning often expands to include longer income replacement periods, especially if children are young. It's also more common to see intentional planning around future expenses like college, even if the full cost isn't expected to be covered by the family alone. What changes here is not just the amount, but the time horizon. Instead of focusing on a few years of support, the goal may extend closer to the years when dependents become financially independent. That shift can significantly increase the coverage needed, even if the household feels financially stable today. For households earning between $150,000 and $300,000, complexity increases again. Expenses are higher, but so is the potential for asset accumulation. Many families in this range have a mix of retirement accounts, taxable investments, and possibly employer-provided benefits. Here, life insurance often serves as a bridge rather than the sole safety net. It's used to ensure that existing plans' retirement timelines, education funding, long-term investments can continue without being derailed by a sudden loss of income. However, this is also where underinsurance can quietly occur. Higher earners sometimes assume their growing assets reduce the need for coverage, but if those assets are tied up in long-term strategies, accessing them early can come at a cost. Taxes, market timing, and opportunity loss all factor in. For households above $300,000, the conversation often shifts toward coordination. Insurance becomes one part of a broader financial structure. That may include estate planning, tax considerations, and legacy goals. Coverage decisions in this range are less about basic protection and more about maintaining continuity across a complex financial picture. It's important to note that these ranges are not prescriptions, they're patterns observed across many U.S. households. Individual situations can differ significantly based on location, family structure, health, and financial priorities. Another variable that cuts across all income levels is policy type. Term life insurance is often used to cover defined periods where financial risk is highest. It's just the years when dependents rely on income. Permanent policies can serve different purposes. But they also come with different cost profiles and considerations that vary by insurer and state regulations. Choosing between these options isn't just about preference. It's about aligning the structure of the policy with the timing of your financial obligations. A mismatch here can lead to either gaps in coverage or unnecessary expense. One subtle risk that shows up across income levels is delaying the decision entirely. Life insurance pricing is influenced by age and health, and while exact premiums vary by provider and underwriting criteria, waiting can change the available options. That doesn't mean rushing into a policy. It means recognizing that timing is one of the variables in the equation, alongside income and expenses. For those who want to stay informed as these factors evolve, especially as income, family structure, or financial goals change, there's a WhatsApp channel linked in the description where updates are shared. It's optional, but useful if you prefer ongoing context. At this stage, the goal isn't to land on a perfect number. It's to understand how your income level interacts with time and financial structure. So the coverage you choose is grounded in reality rather than general advice. There's another layer that doesn't show up in income brackets or expense lists. And that's how decisions actually get made inside a household. Two families with identical numbers on paper can arrive at very different coverage choices simply because they define enough differently. Some people prioritize eliminating uncertainty as much as possible. They lean toward higher coverage so that, if something happens, the surviving family doesn't have to make difficult financial decisions under pressure. Others are more comfortable accepting some level of adjustment, knowing that expenses could be reduced over time if needed. Neither approach is inherently right or wrong. What matters is whether the decision is intentional and based on a clear understanding of trade-offs. One trade-off that often gets overlooked is duration versus amount. For example, a policy that covers a shorter period with a higher payout might protect against immediate risks, but leave a gap later. On the other hand, a longer-term policy with a lower payout might provide broader coverage over time, but require more careful budgeting. This becomes especially relevant when people try to fit coverage into a fixed premium budget. Instead of asking what level of protection is needed and then exploring options, the process sometimes starts with what feels affordable month to month. That can lead to compromises that aren't always obvious at the time. Another factor is how income is expected to change. Early career professionals may anticipate significant growth, which could shift the balance between current coverage and future needs. In contrast, someone closer to retirement may be more focused on protecting existing assets and ensuring a smooth transition. For business owners or self-employed individuals, the picture becomes more complex. Income may fluctuate, and there may be obligations tied to the business. In some cases, life insurance is used not just for family protection, but also to support business continuity. Depending on how ownership and liabilities are structured, it's also worth considering how inflation affects long-term planning. Expenses that feel manageable today may look very different 10 or 15 years from now. While it's difficult to predict exact changes, acknowledging that costs tend to rise over time can influence how coverage is structured. Another area that deserves attention is beneficiary planning. The amount of coverage is only part of the equation. How the payout is directed and who is responsible for managing it can have a significant impact on how effectively it supports the intended purpose. For families with minor children, this often involves designating a responsible adult to manage funds on their behalf. For others, it may involve coordinating with existing estate plans or legal structures. These details can vary by state and personal circumstances, so they're typically addressed alongside broader financial planning. At this point, it's helpful to step back and recognize that life insurance is not a standalone decision. It interacts with savings, investments, debt, and long-term goals. Looking at it in isolation can lead to gaps or overlaps that aren't immediately visible. If you've been following along and this perspective is helping you think more clearly, you might consider subscribing to the channel. The goal here is to continue breaking down these topics in a way that reflects how financial decisions actually work in real life. There's also a practical reason to enable notifications and set the bell too. All these topics tend to build on each other, and missing one piece can make the next feel incomplete. Staying connected helps keep the full picture intact as new information is added over time. Before moving forward, it's worth addressing one final misconception. Some people believe that once a policy is in place, the job is done permanently. In reality, coverage needs can change as life evolves. Income shifts, debts are paid down, children grow up, and financial goals change. A policy that made sense 5 years ago may not align perfectly with current circumstances. Periodic review doesn't mean constant adjustment, but it does mean staying aware of whether the original assumptions still hold. From here, the focus shifts toward practical application. How to take everything discussed so far and translate it into a decision that fits your specific situation, without overcomplicating the process. When it comes time to turn all of this into an actual decision, the process doesn't need to be complicated, but it does need to be deliberate. The goal is not to calculate a perfect number down to the dollar. It's to arrive at a range that realistically protects the financial structure you've built. A practical way to begin is by listing obligations in order of urgency. Start with anything that would create immediate pressure if left unpaid. Housing is usually at the top. Whether that means paying off a mortgage entirely or ensuring several years of payments can be covered depends on how the household would respond in that situation. Next, consider liabilities that carry higher interest or shorter timelines. Credit balances, personal loans, and certain types of private student debt can create ongoing strain if they remain. Including these in your coverage calculation can prevent a situation where surviving family members are forced to make difficult trade-offs quickly. After that, map out ongoing living expenses. This is where many people underestimate. It's not just fixed bills. It includes groceries, transportation, insurance premiums, utilities, and the smaller recurring costs that add up over time. Looking at a full year of spending rather than a single month tends to give a more accurate picture. From there, define a time horizon for support. This is not about replacing income indefinitely. It's about identifying how long financial support would be needed to allow for adjustment. For some households, that might be 5 to 10 years. For others, particularly with younger dependents, it could extend longer. Once you have these pieces, you can begin to see a range forming. It won't be a single precise figure, and that's expected. What matters is that the range reflects real obligations and realistic timelines, not abstract rules. At this stage, it's also useful to account for existing resources. Savings, investment accounts, and any current life insurance coverage all play a role. The key is to consider how accessible those resources are and whether using them would disrupt long-term plans. Employer-provided life insurance is often part of this calculation. In the U.S., many employers offer group coverage, typically based on a multiple of salary. While this can be valuable, it's important to understand its limitations. Coverage may not be portable if you change jobs, and the amount may not adjust as your financial responsibilities grow. For individuals who rely heavily on employer coverage, one approach is to view it as a baseline rather than a complete solution. Supplemental coverage can then be used to fill any gaps that remain after accounting for those benefits. Another consideration is how premiums fit into the broader budget. Life insurance is an ongoing expense and it needs to be sustainable. Choosing a policy that stretches the budget too tightly can create pressure later, especially if circumstances change. At the same time, focusing only on minimizing premiums can lead to underinsurance. The balance lies in aligning cost with the level of protection that meaningfully reduces risk. This balance looks different at each income level, which is why personalized evaluation matters. It's also worth acknowledging that no plan is static. As income increases, debts are reduced, or financial goals evolve, the appropriate level of coverage may shift. Periodic review, even if it's infrequent, helps ensure that the policy continues to reflect current realities. One final point that often brings clarity is thinking in terms of outcomes rather than numbers. Instead of asking, "Is this enough coverage?" ask, "What would this allow my family to do? Would it keep them in the same home? Would it give them time to adjust without immediate financial pressure? Would it support key milestones like education?" If the answer to those questions is yes, the coverage is likely aligned with its purpose. And if you know someone who is trying to make sense of these decisions, you can share this video with them. These conversations are often easier when people have a clear framework to work from rather than relying on scattered advice. At the end of the day, life insurance is about continuity, not perfection, not prediction, but creating enough stability that the people who depend on you can move forward without being forced into decisions they weren't prepared to make. There's one more dimension that often clarifies everything: how life insurance fits alongside the choices you're already making. Not as a separate decision, but as part of a system that evolves over time. For example, consider how savings habits interact with coverage. A household that consistently builds emergency reserves and invests over time may gradually reduce its reliance on insurance for certain risks. Not immediately, and not entirely, but enough that the role of insurance shifts from primary protection to supplemental support. In contrast, households that are earlier in their financial journey often rely more heavily on insurance because assets haven't had time to accumulate. This isn't a weakness, simply a different phase, where protection plays a larger role while other pieces are still being built. This dynamic is why comparing coverage amounts between people can be misleading. Two individuals earning the same income might have very different needs based on how long they've been saving, how their expenses are structured, and what financial responsibilities they carry. Another factor that influences real-world outcomes is how claims are handled and how beneficiaries access funds. In the United States, life insurance benefits are generally paid as a lump sum and are often not subject to federal income tax for beneficiaries, though there can be exceptions depending on how the policy is structured or if interest accrues over time. State-level considerations and specific policy details can also affect the process. What matters from a planning perspective is clarity. Beneficiaries should know that a policy exists, understand how to file a claim, and be aware of any documentation that might be required. These practical details don't change the amount of coverage, but they can affect how smoothly it functions when it's needed. It's also important to recognize that underwriting plays a role in what coverage looks like in practice. Age, health, history, and lifestyle factors influence eligibility and pricing. While this varies by insurer and state regulations, the general pattern is consistent. Earlier planning tends to offer more flexibility and options. That said, not every situation follows a standard path. Some individuals may face higher premiums or limited choices due to health conditions or other factors. In those cases, the focus often shifts toward finding a structure that provides meaningful protection within available options, rather than aiming for an idealized target. Another area that can influence decisions is how policies are owned and structured within a household. In some cases, each partner holds an individual policy. In others, coverage may be coordinated to reflect differences in income, responsibilities, or long-term goals. There isn't a single correct model, but alignment between coverage and real-life roles is essential. As financial lives become more complex, Some households also consider how life insurance interacts with estate planning. This can include providing liquidity to cover estate-related expenses or ensuring that assets can be distributed without forcing sales under pressure. These considerations tend to become more relevant at higher asset levels and often involve coordination with legal and financial professionals. At a practical level, the most useful takeaway is that coverage should be revisited when major changes occur. This doesn't mean constant adjustments, but certain events naturally prompt a review: a new child, a home purchase, a significant income change, or a shift in financial goals. These moments create natural checkpoints where assumptions can be updated. What mattered 5 years ago may not carry the same weight today, and adjusting coverage accordingly helps keep the overall plan aligned. Before closing, there's a simple way to pressure test your thinking. Imagine your current coverage, or the amount you're considering, is already in place. Then ask, if that amount were paid out tomorrow, what would actually happen over the next year? Which expenses would be covered comfortably? And where would constraints begin to appear? This kind of mental walkthrough often reveals gaps that aren't obvious when looking at numbers alone. If this perspective has been useful, you can consider saving the video so you have a reference point when your situation changes. These decisions rarely happen once. They evolve, and having a clear framework makes future adjustments more straightforward. Ultimately, the goal isn't to eliminate every possible uncertainty. It's to reduce the most significant risks to a level where your family has stability. When coverage is aligned with that objective, it becomes less about the number itself and more about what that number makes possible. There's a point in this process where numbers stop being the main challenge and judgment takes over. It's not because the math becomes unclear, but because the decision depends on how you weigh trade-offs that don't have a single correct answer. One of those trade-offs is how much responsibility you expect your family to carry if your income were no longer there. Some households are comfortable with the idea that a surviving partner would eventually return to work full-time or increase their hours. Others prefer to plan as if that transition may take longer or may not happen at all, especially if children are involved. This assumption has a direct impact on coverage. Planning for immediate full income replacement requires a different structure than planning for partial support. Neither approach is inherently better, but the difference between them can be substantial. Another judgment call involves education planning. In many U.S. households, there's an expectation about contributing to college costs. Life insurance can be used to support that expectation, but it's not automatic. Some families choose to prioritize basic financial stability first and treat education funding as flexible, depending on circumstances. These decisions often reflect values as much as finances. That's why two households with similar numbers can still choose different coverage levels. There's also the question of geographic cost differences. Living expenses in the United States vary significantly by region. Housing, childcare, healthcare, and general cost of living can differ by thousands of dollars per month between areas. A coverage amount that feels adequate in one location may not translate directly to another. Because of this, any general guideline should be adjusted to reflect local conditions. This doesn't require perfect precision, but it does mean being aware that national averages may not match your actual cost structure. Another practical consideration is how inflation interacts with fixed coverage amounts over time. A policy purchased today provides a defined payout, but the purchasing power of that payout can change. For shorter-term coverage, this effect may be limited. Over longer periods, it becomes more relevant. Some policies offer features that address this, depending on the insurer and product design, but these features vary and can affect cost. Understanding how your coverage aligns with the time horizon you've chosen helps clarify whether this is a factor worth addressing in your situation. It's also worth noting that life insurance is only one part of risk management. Disability insurance, health insurance, and emergency savings all play roles in protecting financial stability. Focusing exclusively on one area, without considering the others, can leave gaps that aren't immediately visible. That doesn't mean every risk needs to be covered equally. It means recognizing that these elements work together, and decisions in one area can influence what's needed in another. As you bring all of this together, the goal is not to eliminate uncertainty completely. That's not realistic. The goal is to reduce uncertainty to a level where your family can make decisions from a position of stability rather than urgency. If you've made it this far, you already have more clarity than most people who approach this topic. And if you want to keep building on that understanding over time, you can subscribe to the channel. The focus here is to continue exploring these decisions with the same level of detail, without oversimplifying or overcomplicating them. Before closing, it helps to return to the original question, but with a different perspective. Instead of asking, how much life insurance do U.S. families need at different income levels? The more useful question is, what level of protection allows my specific household to continue functioning without major disruption? Income is part of that answer, but it's not the entire answer. Time, obligations, location, and personal priorities all shape the outcome. When those factors are considered together, the number you arrive at may not match a common rule of thumb, and that's not a problem. It's a sign that the decision is grounded in your actual situation rather than a general guideline. And in a decision like this, grounded thinking is what makes the difference. At the end of this process, what matters most is not the specific number you choose, but whether that number holds up under real-world conditions. A coverage amount can look reasonable in isolation and still fall short when tested against how life actually unfolds. One way to bring this into focus is to think through a sequence of events rather than a single moment. If a payout were received, what happens in the first 30 days? Which expenses are handled immediately and which decisions can wait? Then extend that timeline to 6 months, a year, and beyond. This layered view often reveals whether the coverage supports a smooth transition. Another useful perspective is to consider flexibility. Financial plans rarely unfold exactly as expected. Markets change, job situations shift, and family needs evolve. Coverage that allows for adjustment tends to be more effective than coverage that only works under ideal assumptions. It's also worth acknowledging the emotional dimension, even in a financial discussion. Decisions made under stress are rarely optimal. Adequate coverage reduces the likelihood of having to make significant financial choices during a period of uncertainty. That space to think clearly can have long-term effects that aren't captured in a simple calculation. At the same time, there's a point where additional coverage produces diminishing practical benefit. Once core obligations are secured, increasing the amount further may not meaningfully change outcomes. Recognizing where that point lies is part of making an efficient decision rather than an excessive one. For some households, this balance becomes clearer when they compare different scenarios side by side. Seeing how outcomes change across those scenarios can make the trade-offs more concrete. It's also important to revisit the role of communication. A well-structured plan can still fall short if people don't understand how it works. Ensuring beneficiaries know where policies are held and how to initiate a claim can prevent unnecessary delays or confusion. These are straightforward steps, but they're often overlooked because they don't involve numbers. In practice, they can be just as important as the coverage amount itself. As you finalize your thinking, it can help to simplify the decision into a few grounded questions. Would this coverage allow my household to maintain stability in the near term? Does it provide enough time to adjust without immediate financial pressure? Does it align with the way we actually live and spend, rather than how we think we should? If the answers are consistent, the decision is likely well aligned, even if it doesn't match a common formula. If you found this approach useful, you can consider sharing it with someone who is working through similar questions. These decisions are often easier when people have a structured way to think about them, rather than relying on isolated advice. What this entire discussion comes back to is clarity. It's not certainty, but clarity about what needs to be protected. Income level provides context, but it doesn't dictate the outcome on its own. When coverage reflects that clarity, it becomes a tool that supports your broader financial life. And that's where it delivers the most value quietly in the background, doing exactly what it was designed to do. At that point, the question of how much stops being abstract. It becomes specific, grounded, and tied to your household. That's the difference between following a rule and making a decision. Even after you've worked through the structure, the timelines, and the scenarios, there's still a final layer that tends to influence the outcome more than expected. how decisions hold up over time without constant attention. Life insurance is one of those areas where the initial decision often carries forward for years. Policies are set, premiums are paid, and unless something changes noticeably, it's easy to assume everything remains aligned. But financial lives don't stay static, even when they appear stable on the surface. One of the more subtle shifts happens as income becomes less central. Early on, income is the primary engine. Over time, as assets grow and debts decline, that dependency can decrease, and the role of insurance shifts. The role of insurance gradually shifts, but only if the coverage is reviewed with that change in mind. For example, a household that has paid down a significant mortgage and built substantial savings may not need the same level of coverage it initially chose. On the other hand, if new responsibilities have been added, such as supporting extended family, the original coverage might no longer be sufficient. These adjustments don't require constant monitoring, but they do benefit from occasional reflection to ensure original assumptions still match current reality. Another area that can influence long-term outcomes is how premiums evolve relative to income. For many people, premiums feel manageable at the time of purchase, but over time, other priorities compete for the same dollars. This is particularly relevant for policies with longer durations or more complex structures. Keeping coverage aligned with what remains sustainable helps avoid situations where policy becomes difficult to maintain. Consistency is often more valuable than stretching for a higher amount that may not be practical over the long term. There's also a behavioral element that shows up in how people interpret enough. Once a policy is in place, it can create a sense of completion, even if circumstances have changed. This is a natural tendency, but it can lead to gaps if not balanced with periodic reassessment. At the same time, it's important not to overcorrect. Constantly adjusting coverage in response to small changes can create unnecessary complexity. The goal is to respond to meaningful changes in income, family structure, or major debts rather than minor fluctuations. Another perspective that helps is thinking about coverage in terms of phases rather than a single, continuous need. Early career, family building years, peak earning periods, and pre-retirement all carry different types of risk. Aligning coverage with these phases can make decisions feel more manageable and less tied to a single long-term assumption. This phase-based view also helps explain why term life insurance is commonly used for specific periods. It aligns with the idea that certain risks are temporary, even if they last for many years. When those risks diminish, the need for that specific coverage may change as well. For those who have been following this discussion, the key takeaway is not a specific formula or number. It's a way of thinking that adapts as your situation evolves. Income level provides a starting point, but decisions are shaped by how income interacts with time and obligations. If this perspective helped, consider enabling notifications to stay aware when new breakdowns are released. These topics build over time, and staying connected makes it easier to keep your understanding current. In the end, effectiveness isn't measured by a rule of thumb, but by whether it quietly supports those who depend on it. When that alignment is in place, the decision feels less like a calculation and more like a stable part of a broader plan. By the time you reach a decision, most of the important work has already happened quietly in the background. You've identified what needs to be protected, how long that protection should last, and how your income level shapes the structure of that plan. What remains is less about calculation and more about confidence in the direction you've chosen. Confidence, in this context, doesn't mean certainty. It means the decision can withstand reasonable changes without falling apart. If expenses shift slightly, if income grows or pauses, or if plans evolve, the coverage still does what it was intended to do. That kind of resilience is often more valuable than trying to optimize every detail up front. It's also where simplicity starts to matter. A plan that is too complex can be difficult to maintain, even if it looks precise on paper. Multiple overlapping policies, unclear beneficiary arrangements, or assumptions that depend on perfect timing can introduce friction later. Clarity and manageability tend to support better long-term outcomes. One practical way to check for this is to ask whether someone else could understand your plan without needing a detailed explanation. If a partner, family member, or trusted advisor can see how the pieces fit together, the structure is likely clear enough to function. Another aspect that becomes more relevant over time is coordination. As financial lives grow, different elements start to intersect more directly. Decisions in one area can influence outcomes in another, sometimes in ways that aren't immediately obvious. For instance, the way assets are allocated can affect how much liquidity is available in different scenarios. Insurance can provide immediate funds, while investments may be tied to market conditions or long-term strategies. Balancing these elements helps ensure that the overall plan works cohesively rather than in isolated parts. There's also a long-term perspective to consider. For many households, the need for income replacement decreases as they approach retirement. But other considerations may emerge. Final expenses, legacy intentions, or the desire to provide financial support across generations can influence how coverage is maintained or adjusted later in life. These decisions often involve different types of policies or strategies, and they tend to be shaped by personal priorities as much as financial ones. What remains consistent is the need for alignment between the purpose of the coverage and the role it plays within the broader plan. As everything comes together, it's helpful to return to a grounded, practical viewpoint. If your current or planned coverage were already in place today, would it allow your household to continue without immediate financial strain? Would it provide time to adapt thoughtfully rather than react quickly? Would it support the outcomes that matter most to you? If those answers feel steady, the decision is likely in a good place. For those who prefer to keep learning as these topics evolve, there's a WhatsApp channel available through the link in the description. It's simply a place to stay informed as new insights and breakdowns are shared over time, especially as financial situations change. At its core, life insurance is not about predicting every possible future. It's about preparing for the most meaningful risks. Income levels provide context, but they don't define the final answer on their own. What defines the answer is how clearly you've connected that income to your responsibilities, your timeline, and your priorities. When that connection is in place, the number you choose stops being arbitrary. It becomes a reflection of how you've decided to protect the people who depend on you based on the realities you understand today. And that's ultimately what makes the decision hold its value over time.